Chapter 9, Long-Term Assets, Fixed and Intangibles. So fixed assets are long-term, anything that is going to be used by the business in order to generate revenues for more than 1 year. Assets purchased with a useful life of less than 1 year are just expensed as they are purchased. So this includes property, plant, and equipment. Those assets are physically, they're tangible assets. You can touch them, hold them, walk on them, walk in them. They are used by the company in its normal operations. This is key. So if they buy a piece of land, say a piece of unimproved land, that they're not going to be using in operations yet, it's for future expansions, that is not property, plant, and equipment. That is not a fixed asset. That is an investment until such time that it begins to be used in the business. So classified cost are going to fall into three categories. They're either a fixed asset, they're going to be used for more than 1 year in the operation in order to generate revenue. An investment, this is a long-term asset that is not currently being used in operations. Or an expense, and this would be, like office supplies, items such as that are not going to be used for more than 1 year. So classifying them, you're going to go through a flow chart. So is it long lived? Is it going to be used for more than a year? If no, it's an expense. If yes, is the asset used in normal operations? If that answer is no, then it's an investment. And if it's yes, then it's a fixed asset. So this includes land, buildings, equipment, the machinery, vehicles, and the like. So you're going to capitalize as a fixed asset everything that is expended in order to put the asset into service. So for a building, if you're building it from scratch, it's all the fees that you pay, both the engineers and the architects. It's any insurance during the construction phase, any interest on money during the construction phase, all of the permits from various government agencies, as well as the cost of construction. So machinery and equipment includes the sales tax paid on the purchase, if there is any freight that you have to pay in order to get the asset to your place of business, and any cost of installation. You may have to rent a crane in order to take the machinery off the back of the flatbed truck and put it on to a remote dolly in order to get it to, roll it through your manufacturing factory and get it into place. There may be another crane inside to pick it up off that dolly and put it into place. You may have to build safety equipment, railings around it in order to put it into place. You may have to use some raw materials in order to test it and calibrate it in order for the equipment, be it a press or a molding machine, in order for it to be placed into operation. So everything associated with the land in order to get it into operational status. So cost is necessary that items that are not included in the cost of the asset are any vandalism that occurs to the equipment either in transit or while it's being installed, any mistakes that are made, errors that are made in the installation process, theft, damaging during unpacking, fines for not obtaining proper permits from governmental agencies, and the like. So here's an example. We purchased equipment for $12,000. We paid $600 to transport the equipment. Installation cost of $1,500 were incurred, which include a $500 mistake that was made during the installation. So the equipment is going to be the $12,000 plus the $600 plus the $1,500, plus $1,000 of the $1,500 installation. We are not going to capitalize as part of the equipment the $500 error. Okay, that's going to be recorded as an expense. So buildings especially, we may have a temporary account called construction in process where we'll accumulate all the costs associated with constructing a new factory, a new office building, and then once that is placed into service, we'll credit that construction in process and debit the building account. So what we're going to do with long-term fixed assets, property, plant, and equipment, tangible fixed assets, is we're going to expense them in a systematic manner over the life of the asset. Okay? The one exception to that is land. Land is considered to have an unlimited life, and it is not depreciated. So every other asset then is going to be depreciated in some manner. The reason we depreciate this is once again to closely match the cost of a long-lived asset with the revenue being generated. And assets, tangible assets, they depreciate. They're subject to wear and tear, and they wear out. They're not as efficient over the beyond their useful life, and will need to be replaced. So it's not a decline in market value. Some assets, like buildings, for instance, may appreciate in value, but we still expense them in order to match the cost of the original cost of the building with the revenue being generated. So the three items that we need in order to calculate depreciation is what is the total initial cost. This is the total cost to place the asset into service. What is its expected useful life? Over how many years or months are we going to utilize this asset in generating revenue? And then when it's finished, what do we estimate the value, the scrap value, residual value of this asset to be? So the initial cost is the purchase price plus all costs to obtain and place it into service, as I've mentioned to you. The useful life is an estimate. It's an estimate. Some of it is standardized. Some corporations use tax estimates that the IRS guidelines publish. Computer equipment typically is depreciated over a 3 or 4 year period. Cars over a 5. Delivery trucks and some types of manufacturing equipment could be as much as 10 years. Buildings can be 15 to 30 years as far as useful life. So companies will have guidelines and estimates that they place various categories of assets into. The residual value is what we expect to trade it in, to scrap it, to salvage it. What are we going to sell it for once we're finished utilizing it and generating revenue? So the difference between the initial cost and the residual value is known as the depreciable base, the depreciable cost. All right. So here's a forklift that we initially purchased for $24,000. We expect to use it over the next 5 years. And at the end of that 5-year period, we're going to trade it in on a new forklift and get $2,000 value out of it in trade-in. So the depreciable base then is $22,000, and we'll expense that $22,000 over year 1, 2, 3, 4, and 5 based upon one of 3 methods that are most frequently used. Those 3 methods are straight line depreciation, units of production or units of activity depreciation, and then double declining balance. Now you could use all 3 of these. I mean, you could use straight line depreciation for computer equipment, you could use units of activity for generators, for cars, for delivery trucks, for machinery, and then you could use double declining balance on buildings and stores and office space. So a company can use all 3 types of depreciation. Straight line depreciation is most common. It is simply the cost minus the residual value or the depreciable base divided by the useful years. And so in the case of the forklift, it would be $4,400 per year each year over the 5-year useful life. So $4,400 per year. So computing straight line depreciation is the straight line percentage is simply the 100% divided by the number of years. So 20% for a 5-year property, 12.5% for an 8-year property, 10% for a 10-year, 4% for a 25-year. It's just 100% divided by the useful life in years. And we'll be using that later when we get to double declining balance. So the entry then, and you've seen this since Chapter 3, is a debit to depreciation expense for the forklift for the year, $4,400, and a credit to that contra asset account, accumulated depreciation on forklift. The book value is the original cost minus the accumulated depreciation. So that at the end of the first year, the book value on that forklift is $19,600. And then that will decline each year, going down to $15,200, down to the residual value of $2,000 at the end of year 5. So units of activity, units of production method is taking the cost minus the residual value, so using the depreciable cost of the depreciable base once again, and now dividing it by an estimated units of activity. Units of activity could be number of units produced, it could be hours, it could be miles, whatever activity base the company decides to use. So on back to the forklift, we estimate that it's going to have 10,000 operating hours over that 5-year period. The first year it was operated 2,100 hours. So the depreciable base of 2,200 divided by the 10,000 hours will give us $2.20 per hour. Multiply that by the first year's actual activity, the number of hours that the forklift was run, and that gives us a $4,620 entry for depreciation expense. Then the year 2, we ran it for 1,500 hours. There were 2,600 hours in year 3, and 4 and 5 for the total of 10,000. So there's the various depreciation and the book value at the end of each year. Note that the book value once again went down to, in year 5, the $2,000 residual value that we would then trade it in for. Double declining balance is used by companies for a variety of reasons. Two primary are that as an asset ages, the repair and maintenance cost on that asset will increase. So double declining front-end loads the depreciation into its early years, taking more depreciation in year 1 and 2 than it does in year 3, 4, and 5. And so with the increasing amount of repair and maintenance, this kind of flattens it out. So as depreciation decreases, repair and maintenance costs increase. The second primary reason that companies use double declining is that when a asset is brand new, it is at its most efficient, it's the latest technology, and therefore it should generate the most revenue in its early years than it will in the later years as obsolescence begins to set in. So we're going to determine the straight line percentage, and I showed you that earlier. That's just 100% divided by the useful life. So in the case of the forklift, that is 20%. And then we're going to double that. We're going to multiply it by 2, which would give us a depreciation rate of double declining balance rate of 40%. So 5 years, straight line is 20%, double that is 40%. We then multiply the initial cost. Now, be careful here because we're not going to use the depreciable base. We're going to use the total initial cost. And so $24,000 times 40% is $9,600, and that will be our entry for depreciation expense. We then come up with a new book value, the $14,400. That's the $9,600 subtracted from the total original cost of $24,000. Multiply that $9,600 by 40%, that $14,400 by 40%, and that gives us depreciation for the second year of $5,760. The new book value is now $8,640 times 40%, $3,456. You do that over and over again until you get to the final year. And in the final year, the book value at the beginning of the year is $3,110.40. You then depreciate that down to the residual value of $2,000. So you would only take in year 5, you're not going to multiply that $3,110.40 times 40%. You're just going to subtract $2,000 from it to get depreciation of $1,110.40. So the estimated residual value is not considered until the other than to depreciate it to that amount. So you see, once again, we take book value $14,004 down to $8,600, $51, $31, and then finally $2,000 for the residual value. So here's a summary. Straight line is cost less residual value multiplied by the straight line rate or divided by the useful life. The units of production is also it varies based upon the number of hours that or units that the machinery produces, and then double declining front end loads the amount of depreciation. So you see here we had 9,600 compared to 4,620 for units of production, or 4,400 for the straight line. So straight line is the same. The units of production vary based upon the number of hours that the forklift was driven, and then the double declining decreases each year down to the final year of only $1,110.40. So assets are often repaired or improved over their life, and so if it's just repaired, you're changing the oil in a delivery truck, replacing the spark plugs, replacing the brake pads, that is expensed as incurred. If you do a capital improvement to it, extending the useful life, so you put a new engine into a delivery truck, you originally thought you would use the truck for 7 years, but now with the new engine, you'll use it for 10 years. So increasing its useful life, that will be capitalized. So ordinary repair and maintenance are expensed as incurred. So tune-up on the delivery truck is just expense, $300 debit to repair and maintenance expense, and credit to cash. If such asset expenditures extend the life, so we take the forklift, we put a new overhauled engine into the forklift at a cost of $4,500, and that's going to extend the useful life by 8 years. So we're going to debit the accumulated depreciation on the forklift and credit cash, and then recalculate the new book value over the remaining useful life and depreciate it that way. Okay, so here's another example. We've added a $5,500 hydraulic lift to allow for easier and quicker loading. The cost of the delivery truck is increased. It is going to benefit future and current years. It's an asset, and so we will debit the fixed asset and revise the depreciation. Discarding a fixed asset, whether it's reached the end of its useful life or not, we will this is a fully depreciated asset, a piece of equipment, and we discard it for zero value. We just haul it off to the scrap yard. So that's a debit to the accumulated depreciation, zeroing out all the depreciation that we've taken on the equipment over the years, and then a credit to the equipment to zero out the original purchase price. So if it's not fully depreciated, then we're going to depreciate. So this is a piece of equipment costing $6,000. It was estimated over 10 years, or a 10% straight line rate, $600 per year. We get rid of it at the end of March, on March 24th. So we've used it for January, February, and most of March. So we will first depreciate it for $150. That's 1/4 of the year, and then at that point we'll write off the equipment. So the new depreciation, accumulated depreciation, we had $44,650, added $150 to it for $4,800 now, and that's a loss on disposal of equipment for $1,200. If we sell it, then we have the possibility of a gain or a loss. If we sell it for more than its book value, we will have a gain, and that's reported on the income statement in that other revenue and expenses on the multi-step income statement. And if we sell it for less than its book value, then it's a loss. So here's a piece of equipment, once again, over 10 years. Original purchase price was $10,000, so we're doing it as $1,000 a year. We sell it for cash on October 12th, and so the depreciation for the 9 months that we used it was $750. That brings the book value down to $2,250. If we sell it for exactly that, then we have no gain or loss. We just record the wiping out the accumulated depreciation and the original cost of the equipment. If we sell it for $1,000, then we have a loss on sale of equipment of $1,250. And if we sell it for $2,800, then we have a gain on sale of equipment of $550. So we're almost finished. We're going to briefly go over intangible assets. These are assets that do not have physical substance. They still have value. The things like patents, copyrights, trademarks, goodwill, franchising agreements, customer lists, a variety of intangible assets that are generated during the course of business. These are amortized. So while tangible fixed property, plant, and equipment is depreciated over its useful life, intangible assets are amortized over the useful life. So the federal government has the right to issue patents to organizations. They give you the right to use that invention for 20 years. You could buy a patent from somebody else that could be in the middle of its 20-year period, but for the most part, 20 years is what patents get amortized over. So the initial cost is legal fees to initially file for the patent. It is not the research and development to create the patent. It's just the cost of filing for it, or if you had to go to court to defend the patent. So these are done over a straight line basis. So we're going to acquire a patent, buy it from its original inventor for $100,000. Even though it has a legal life of 14 years, we're only going to use this patent for 5 years. So we're only going to amortize it over the years that we expect it to generate revenue. So the amortization expense on the patent on an annual basis is $20,000. The $100,000 divided by the 5-year useful life. Okay, as I mentioned, research and developments are expensed as an operating cost in the period in which they are incurred. Copyrights are good for 70 years beyond the author's death. This is literary, musical compositions, and the like, which is why you can go out on the internet and download for free Mark Twain, Shakespeare, Plato, and the like, but you have to buy Hemingway. You have to buy the music generated by the Beatles. So these are, whereas you can find for free the music for Beethoven and Bach and the like. Okay, 70 years beyond the author's death. Trademark are unlimited. They register for them for 10 years. So the Nike swoosh, the McDonald's golden arches are good forever. The cardinal with a red beak that UIW uses as a trademark, all of these are good for 10 years, and then you renew them every 10 years after. I'm not going to go over goodwill. So these are various types of intangible assets, and that is that. Okay?